The increase in production is because stage one of Saudi Arabia's plan, or perhaps hope, to restructure the oil market is taking longer than expected. By refusing to rein in production while prices fell, the Saudis permitted a big surplus to grow and served a notice on higher cost rivals including Russia, Venezuela, American shale oil producers that they would not prop up other people's profit margins at the expense of their own market share. That signal has been weakened by the growing amount of oil in storage, which is absorbing most of the glut. World oil stocks rose about 265 million barrels last year, and Société Générale, a French bank, reckons they will increase by a further 1.6 to 1.8 million barrels a day in the first 6 months of this year, adding roughly 300 million barrels to the total. At the moment, global oil output is exceeding demand by about 2 million barrels per day, so the build-up of stocks is enough to take most of the glut off the market. Oil is being stored in the hope that demand and prices will pick up later. So, stocks plus renewed political worries. Flows from Libya's largest oil field were disrupted again this week by apparent sabotage, have pushed the price of oil back over $60. After having fallen by more than 60% since June, the price of a barrel of Brent crude closed above $62 on February the 17th.
With the decision of Saudi Arabia to leave the oil price going down, you can see that Saudi Arabia is back in the middle of the game. The others, they don't want to do nothing. My peers in OPEC, they will look to me to do most of the effort. So I think they decided that it was not up to them to lose market shares, which is the truth. They were losing market shares, to be honest. And they decided to let the market go. Probably the price went down very quickly, and I think lower than they expected. You notice that Khaled El-Faleh recently said that the price is too low for everybody.
The restocking cannot continue for long. Storage facilities in Europe and Asia are already stocking 80 to 85% full. Much more and they will overflow. As it is, companies are renting tankers to keep oil in. If storage space runs out, prices could tumble again. Whether that happens depends on how quickly Phase 2 of the Saudi plan gets underway. This is to force high-cost producers out to increase the influence of Gulf countries. In the long run, there are signs that a restructuring of the market is starting, which could eventually lead to high-cost producers going bust or marginal areas being abandoned. Anita Mwangozi, WBS News in Kampala.